Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Patrick, time flies. I think we're getting closer and closer to completing 2 years with Practical Nerds. Not yet, but almost there.
And almost 70 episodes. So
Yes.
that's for me almost the, I don't want to say scarier, but more surreal part. To this day, you and I don't know what our analytics look like. We literally don't know who and how many people are listening to this. And you know why? Because you and I were just using the time to talk to each other and have a recording device with us. And now to have done exactly that nonsensical process 70 times, it's pretty fun when you think about it.
I know. It's quite crazy. Quite crazy.
Yeah. So today, I don't know how to segue this, so let me just...
I actually had thought of something.
Oh, you have a segue. All right.
While the intro was playing, what I thought I would do is to say, hey, look how I'm already starting to preempt our 2-year anniversary.
Well done. Well done. You did indeed preempt that.
Yes.
And preempt is a word that founders attach positive connotation to in the context of fundraising. Many of them would. Let's start with the definition in case you've never considered this word in the context of fundraising for your construction tech, AEC tech company. It's VC jargon. And so it basically means that, hey, you are not planning to fundraise currently. Hey, you don't need money currently to achieve the milestones that you have set with the capital that you raised last. But here is me as an outside investor coming and saying, I would like to give you money nonetheless, and I would like you to take it, and here are the reasons why. That's called the preemption. You preempt the next planned financing round, and you preempt the competition that comes with it. So it can be sort of the dream scenario for a construction tech company because, and we'll get to that. Now, it can also be a tricky and treacherous scenario because unfortunately, there's option value here that the VC tries to extract. We'll come to that as well. So it sounds great. The actual execution is very, very difficult and can be unpredictable. We'll work through that in this episode. Maybe, Shub, a good way to start is what are actually the conditions under which we have seen successful preemptions? Timing, circumstance, situation. What are those conditions that we have seen preemption go well?
I think maybe we can split it into different categories. So one is dependent on the firm itself, like the startup or the portfolio firm. The second is tied to any particular investor in question, and the third maybe more macro or sentiment related. I think when it comes to that specific startup, I think if it is or is perceived to be executing very, very strongly, either word gets around or in select circles it is known that it is getting very it is delivering very strongly on its promises and consistently outperforming what it promises and is seen as a leader. And by the way, definition of a leader is very vague. So in our cases, what we ideally would like is very clearly measurable basis for why a firm would be considered a leader. But that isn't always the case, mind you, especially with a lot of AI-related hype kicking in. How firms define who's a leader can be much more vague than apparent. So it could come down simply to backgrounds or whatever. Basically, what you need is a reason to believe that the firm is special. When it comes to something involving VCs or a particular VC, I think it is usually a case of a VC firm, or more specifically, an individual at a VC
Mm.
firm, whoever is the investment professional leading that interaction. They've kind of really latched on to something with the company they're looking at, and they really like what they see. Maybe it's a very strong relationship with the founders, or they've understood the market very well, or at least believe they've understood the market very well, right? Or they're just giving into FOMO, perhaps, right? So that's also very much possible. But what you need is an individual, hopefully with some influence in a VC firm, to clearly fall in love with the opportunity. That's also, I would say, one of the possible conditions for a preemption. And third, which is the more macro thing, and this is something we used to constantly see in 21, for example,
Mm.
anything and everything would just randomly get preempted because preemption was the norm. So it was not even preemption anymore. It was just the moment one round is done, you would want to preempt, and the preemption would result in a new round altogether and a new FOMO style bidding up process.
Back
So,
then they had the acronym from sales, there's ABC, always be closing. Back then there would be the acronym ABF, always be fundraising.
okay. Can you think of any other conditions which could lead to like a successful preemption?
I can't think of a successful preemption in my history of doing this where the company wasn't on some arbitrary metric. It's not always revenue,
Mm-hmm.
growing very, very fast in the perception of people. And that growth was purported to the outside world. So people who are not currently shareholders and leaked somehow. And actually, it doesn't even have to be always accurate. It's for some reason,
Yes.
sometimes the situation becomes, hey, they are doing extremely well,
Mm-hmm.
etc.
Yeah.
The thing with preemption is that needs to then be backed up. So actually just saying, oh, I'll make all my angel friends talk about that in the ecosystem, that's way to burn a reputation if you do
Mm-hmm.
that once too often, or if you just do it for your company.
Yeah.
Because eventually you will have to reveal those numbers, unless we're back in 2021. Then people actually wrote term sheets without even looking at numbers. So
Yeah.
hopefully that's not what you're going for. So in some kind of sometimes even arbitrary metric, you will have to demonstrate insane growth. Actually, the better term is almost velocity. You need to demonstrate velocity. So that's one. And another thing about the situation is you need to make your shares unavailable. So everybody wants to, I mean, in dating, right? People want to be associated with the people they cannot get. That's human
Yes.
psychology. And in purchasing shares, it's the same thing, and to a degree even worse, because there's only so much equity that you can ever acquire in a highly successful company. There's literally only 100% going around, and that 100% is even going to get diluted even
Yes.
further. So it's much, much, much less than 100% to begin with, and that is much, much, much less due to the dilution effect.
Mm-hmm.
Which means that the shares generally available in exceptional companies is very limited. You can make them even more scarce by not having them on the market. So one of the conditions by which you will never get preempted is by constantly talking to investors.
Yes.
Sorry, I should specify that. You can talk to them, meeting for
Mm-hmm.
coffee, sharing high-level information about what you're doing, how you're thinking. Actually, that is conducive to
Mm-hmm.
it, because if people become comfortable with you as the operators and sort of the general direction that the space and then the direction, that's actually conducive to being preempted. No one preempts you without having ever met you, right?
Mm-hmm.
But what you must not do is then actually talk about, hey, by the way, these are the specific revenue streams, these are the details here, and by the way, I'm not fundraising, but actually, I would entertain offers. If you put your shares on the market, that's not a scarce good at that
Yes.
point in time. So these are a few additional situational factors that I have seen.
Yeah, I think you're spot on. I think there's also like a nuance, which I guess is a cross section of the company specific aspect as well as the investor or investment professional specific aspect, where we also need to call out perhaps a distinction between internal preemption and external preemption, where hopefully, if it's a case of internal preemption, the individual at the VC firm who's driving the process has already actually built that relationship and that conviction through a relationship that's been very purposeful, and both parties have got to know each other, and there's a reason for that preemption, which is backed by solid data.
Absolutely. And you're right. I mean, in the VC firm, you have to have a real champion, and that champion needs to be a decision maker. And by decision maker, I actually don't mean sitting on the investment committee. That's not good enough. It
Yeah.
needs to be someone that can actually bang the table in the investment committee and with personal cachet, make sure that her or his partners are going along with
Yes.
this. And that can happen in small setups, that can happen in large setups, and it cannot happen in small or large setups. You'll have to get a feeling for the person's conviction standing, past operation in these kinds of situations. So I think that's a very important factor on the company itself. Now, when you hear us describe this, though, Shub, how many times out of the 60 portfolio companies that we have, and each of them, let's say on average, has done 2 fundraisers after we invested, so it's maybe 180 fundraisers. How often have you seen a situation where a preemption was in the cards?
If I had to take a random guess, I would say maybe 10.
Yeah, I would have gone with 5 actually.
Hmm.
Yeah. And the reason why I say that is sometimes things look like preemption in order to acquire information about the company, but in the end, there was truly never intent.
Yes.
So I think if you define the preemption in the narrow definition of there was true intent and it actually happened, probably 5.
Yeah. I think that you might be right. Yeah.
So that leads us to a problem with preemption, and I think it's on the mind of very experienced founders more than if perhaps this is the first time you're exposed to that process. Mm-hmm. And that is, hey, are the intentions genuine, and how can I read that? So let's start with why is that a question, and then how can you read that? So that can be a question because when you make yourself not available to the VC market, you're in between rounds, your head's down, all of the monikers. Mm-hmm. And you're just, sorry, I'll add one other one. I'm laser focused right now. Mm-hmm. Then the information is not available to the outside market, which I absolutely love. That's how almost all the founders that I enjoy working with operate, create information asymmetry, because there's absolutely no benefit for you to telegraph your plans to your competition or to people who could leak it to the competition. Absolutely no point in doing that. But when you do that, you're creating another situation for VCs whose job it is to have you on their radar and who get judged internally if that round happens without them ever seeing the round. That means they reach out to you. That means they try all kinds of means to talk to you. And you know what is the meanest mean? Letting someone know, hey, I'm really interested in preempting this. And that's your game of acquiring information about the firm, because you will then look better internally. And you will have a defense in case something happens in the future. That's a very mean way of doing that. But unfortunately, I would say 50% of the supposed preemptions are exactly like that.
I would say much more than 50%.
You think much more? Okay.
Much more, yeah.
So how do you then read that? How do you foster the situation where the person is genuine?
I think what I'd like to come to the answer in a bit. I think before that, what could perhaps frame it, and I think it'll set the tone for what could help prevent such a situation or filter out such situations, is to very clearly define what are your expectations as a founder or as an existing shareholder from the preemption, right? And I think the reason why it's very important is, look, we've been in all 3 possible positions involving a preemption. We have been the one on the outside wanting to preempt entry into a new company. We have also found ourselves being an existing investor preempting continued participation or continued leading an existing position in our portfolio companies. And we also been a shareholder who's witnessed someone else preempting a position into our companies. By the way, I think the 5 or the 10 that we guessed earlier is, I think, the third case of
Yes.
these three, right? Just to be clear for our viewers and listeners. And I think what I've seen, and tell me if this resonates with you, there have also been cases where, we have silently witnessed, or maybe not so silently, witnessed a preemption which we eventually regret 2, 3 years later, right? And I think it usually came down to not properly assessing what expectations we had, what we wanted to achieve from the preemption, and more importantly, what it meant for the future. I
There's a
think
real
not
there's
enough people discuss and weigh in on what that should be.
there's a real problem when you being a founder or shareholder think the value of preemption is more money in a quick way. The problem that you can be creating relatively often is getting an investor with relatively low conviction, because they invested on momentum signals, but not necessarily on the timeless part of your company and being in line with that. So to your point, I just want to double underline that is an issue that you need to navigate. A perfect preemption is not the preemption. A perfect preemption is getting the money at the dream price from the partner at the dream price with conviction to run through highs and lows with you.
I'm glad you brought that up. So actually, that was going to be one of the problems I was going to highlight as one of the. In fact, I would probably say perhaps the most common issue with the preemption that has taken place is the valuation itself, right? I think in most cases, and this was certainly true a couple of years ago, or 3, 4 years ago, maybe still is the case right now. Actually, maybe not the case anymore. Maybe it'll be more in the latter. But in a lot of preemptions, what happens is an external investor would sort of just get in with a high valuation to sort of successfully execute the preemption. But then, unfortunately, because the valuation is quite high, as in it was just meant to be like a tactic to win the deal, or quote unquote win the deal, it then becomes this artificially high hurdle for the company to clear in the next round. So your
100%.
preemption has kind of nuked your chances for the next round, or at least made it much harder.
100%. And that becomes a problem if you treat the preemption as additional cash to burn. You need to treat it as your next round, literally. And so now, because you have moved forward that next round without necessarily, typically you would not have the milestones for it. Otherwise, it wouldn't be a preemption necessarily. Some exceptions exist. Now you actually have to build those milestones with the old money. Shub,
Yes.
with the old money. That's the point. So if you now take the new money in order to achieve the old milestones, think about what that means. You're just setting yourself up for a capital inefficient journey. Now,
I mean, look, how many times, just to put numbers into perspective for our audience, how many times have we heard, Patrick, some company will randomly raise an overpriced round, say, hey, we got this investor, so we raised it at 100 million cap as a safe, but now we're doing a down round, at a 40 million or 50 million. It happens incredibly often.
50, 60 times would be my guess.
Yeah.
Very often. But that's the reason, right? Because now you're touching you just mortgaged your future, and you're using the mortgage money to buy furniture or to go on a holiday. Not good. You need to use the old money to hit the milestones for the preempted round.
Yes.
Right? So, yeah, I think that's an issue. Now, to take the other side of the coin, not of the argument, but of the coin, when investors asked me in the past, hey, so what would it take for me to lead that company and we don't even let it go to the market? Happened maybe 3 times in my portfolio. I'm sorry, the sponsorship of this topic is because I have a situation right now like that in my European portfolio. I think it's pretty much a done thing. And so people ask me then, and I say, look, you are essentially trying to avoid competition, dear net new investor. You are afraid that when the new round comes, you are not getting the deal. That's the fear you're trying to circumvent by preempting and taking the asset, preventing the asset from coming on the market, which means you need to pay the next price.
Yes.
Because you can't expect the benefit of no competition and getting a deal. That does not work. The benefit of no competition is that you get the deal, but you get it for the price that we think the market will pay for the asset.
Yeah.
At that point in time. And that's by definition a premium, not a discount. And that's something else to keep in mind. So if you go to, and that's important for the founders, because for them, the risk is very high for the reasons that we just mentioned. You could get the wrong partner. You don't know them. You haven't worked with them for a long time. There is a risk that actually there is no conviction-based investment behind a preempted fast process. It might actually be that 2 years later you find out, hey, this guy orphaned me because the last process was too expensive, or it was too quick, or both. So there's a good amount of risk associated with it. That's different with internal preemption. With internal preemption, you know exactly who you got. You can talk about the process. You know that there's conviction behind that already. With an external investor, that risk is higher, which means you need to pay the risk or receive the payment for the risk. And that needs to be at the very least the valuation at the next round with today's milestones.
Yes. Yeah. I think with that said, let's maybe dovetail into the conditions that need to exist for a preemption done right. In your mind, what would that look like?
Nice setup. So number one, you must truly not be on the market. The market sniffs you out if you're doing a roadshow and you're just calling it a preemption. It always gets sniffed out. Not only will you use credibility, you might actually lose your fundraise if done poorly. That is especially true if you operate in an ecosystem where it's very chatty, very blabby, and especially when associates get involved or junior investors, they tend to chat and blab even more. So you need to contain. If you do a roadshow, it's by definition not a preemption anymore, and you will get made. The chances are you will get made. So that's the first. You genuinely need not be on the market. The second is, I have never seen a preemption that eventually we were happy with. So not on the day it happened, but like 2 years later, done by a person that hadn't known the company for at least 6 months. Never.
I would agree with that.
There needs to be mutual comfort with each other. And yes, the people typically don't have data. They don't know numbers. They don't know specifics about go-to-market, etc. But they have comfort with, hey, I understand what you're building. I understand the direction you're building towards. And I have found a chemistry and chemistry with you and an appreciation for you as founders. That's almost always a condition. And so that means you being off the market doesn't mean you don't talk to investors that you like. You can, but it is about what you share and what you don't share. Share about yourself, share about your journey, your origins, your destinations and ambitions for this company. Share about, the rough direction, broad strokes that you're taking for the next 12 months. And I've always found a great point being share the milestones that you're going after for the next round. If you can be that specific, it leaves a very strong impression on me, understanding what you judge yourself by, and that gives me comfort and that wants me to be closer to you, etc. A good trick, by the way, that I really recommend my portfolio companies always is, hey, in between rounds, decline talking to investors via phone, Zoom, or email, because it doesn't foster that proximity.
Yeah.
But if an investor tells you, hey, I'm going to be in your city, can we meet for a coffee? Take that coffee.
Tell me, so I fully agree with everything you just said. Now, to take the other side of the argument, suppose if a founder were to say, hey, that is great, and I love this person who's been meeting me, who's been building this relationship with me, but am I losing out on the optionality of discovering a true valuation, right? A true valuation, or discovering maybe what other great partners in the market look like? Shouldn't I give myself a fair chance to have all those other discussions? Why do I need to go into a preemption?
Yeah, I think that's especially true if you're pretty much alone on your cap table. So if you lack the ability to reference other investors and reference the pulse of the market, then I think a roadshow is always, 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 always going to be better for you. If you do have partners on your cap table, could be angels, could be VCs, that are very good at sensing the pulse of the market and at referencing potential investors to talk to. Referencing, by the way, that is important now. Referencing doesn't only mean, yeah, that's a good guy. Oh my God, that brand is good. Nobody gives a crap. Okay.
Yeah.
Referencing is about, yes, that person has done what they say they do. Yes, that person has the sway internally. Yes, that person has the competence to help you with the next round. And once you have people on your cap table that can reference and curate that, anyway, you're not ending up with a roadshow list of people anymore. All of a sudden,
Yeah.
you're like 2-3 people. Literally, that's what it always is. And these 2-3 people are on that list because they are literally your perfect investor. So if you can reference it that way and have that process, it's actually much better than a roadshow for you, because you can just immediately cut out all the noise out of it. And you can still have a competitive scenario. So talking to one external fund, that's perhaps not in your interest, but talking to 3 is a good size.
Yeah. I mean, the one thought experiment I like to do with founders when I'm in that sort of situation, and this would be a situation where I'm an existing investor and this is considering the possibility of an external preemption, is, hey, if this investor who's been quoting us comes in, and let's say they make a certain offer at a certain valuation, right? Would you rather have them at this valuation or another investor? So some person from another, let's call it equivalent fund, at a 10% valuation. Who would you like to work with? At a 20%
10% lower
valuation.
valuation, you mean?
10% higher. So the other,
10% higher, okay.
yeah. So let's say the other party offers that we don't yet have a strong bond. So we are considering a theoretical possibility that in the future, with an open process, with a full roadshow, etc., we get this other party in, and they offer 10% higher valuation. Who would you rather like to work with? 20%. Who would you rather like to work with? I think in my experience, if the delta is more than 20 to 25%, in any case, either something is broken, in the sense either the valuation offered by this the investor seeking a preemption is too low, or there's something wrong with the founder's expectations. But let's say if the founder's expectations are spot on and they are within the deviation is less than a, say, 20%-ish range of what you think you could get, I think at that point, in my opinion, it's better to optimize for the quality of the relationship and for, call it, the higher probability that it will convert instead of going the full process, etc.
It's an interesting framework. One aspect we didn't discuss about the situation is market volatility. So let's say someone offers your portfolio company, whatever, 25 million round, and you still have 25 million in the bank.
Okay.
The discussion with founders typically goes 2 ways when that happens. It's almost always these 2 things. One founder will have a very strong reaction. I don't need the money right now. I don't want to sell my equity because I feel safe. I feel certain. I don't even know where to put it. That's a good mindset.
Yeah.
And the other founder will typically say, I don't know it, but I really like that. I don't need it, but I really like that person. And by the way, that would be a terrific brand. Maybe they could open other doors up for us. So there's always some kind of hopium baked in of some value add beyond the money. It's always these 2 things, Shub, when that happens. Now imagine you as a shareholder now in that situation, take more of a macro view, which I know you do. And you're like, hey, I think there's storm brewing on the horizon. Or maybe there's just the risk of storm brewing on the horizon. How does that factor into what you tell the founder?
Yeah. In general, in that sort of situation, if that's what I perceive, I would generally encourage the founder to go with it, assuming this investor seeking a preemption meets all the other conditions, that we have comfort, that they truly understand the business, they're aligned, and so on and so forth, and they're also offering terms that are not that are mostly aligned with what we are seeking. So I would, in general, in that situation, be in favor of such a preemption. And I have, in the past, been in support of such a preemption.
So I'm with you, but with a nuance. I'm in favor of the situation when I have a... Sorry.
Someone else is preempting your attentions.
Very much so. Clearly, I'm not supposed to say what I'm about to say. Um, I would be in favor of that situation when I have the feeling that the founders can be disciplined stewards of the additional cash. So
yes.
if that would go into bad bets, badly managed, which let's not fool ourselves, Shub,
It
that's going to
happens
be
way more often. It's
990 out of 1,000 founders.
Yeah, that's right.
Then I would probably tell the founders, hey, listen, that's the real risk here. The founder would typically say, but no, now that I know that will not happen. It does. Things have a way of making you spend cash when you have it. It takes a extremely well-organized company to decide on capital allocation in a structured and methodical manner. And that, I deliberately say organization and not founder, is not necessarily the founder being disciplined. It's having built an organization around spending cash, in absorbing cash and spending cash. If that company is at exactly that stage, take the money, absolutely, because then it will be put into, maybe money market funds, bonds, whatever, while you don't need it. I have a robotics company in my portfolio that is exactly like that. Raised way too much because they were offered, but the founder said, I'm not going to touch 80% of that money.
I mean, there's quite... Oh, sorry to speak over. Go ahead. Yeah. There's quite a few portfolio companies we have who will put it into high yield, fixed income sort of instruments. I think that's generally something also we have encouraged. Tell me, there's one important thing we need to cover before we wrap up. It is the external preemption versus internal preemption.
Oh yeah.
Right. So what's the pros and cons over there?
I can project it on ourselves, actually. Maybe that helps. So for us, Shub, we have a comparatively small shareholder base in Fundamental. It's 10 shareholders, right? That are not you and me. So 10 on top of you and me.
Yeah.
And every fund, we've added very, very small number. And all of the previous investors have always come back. We have a very high re-up rate in terms of percentage of check, and we have 100% re-up rate in terms of coming back. Why do you think that is the case? Because we care about our existing investors more than we care about new investors. That has certain benefits. I know my partner. I know what I can trust them with. I know their limitations. I know how to work with them effectively. I know how to make them happy so that then they come back and make me happy, etc. There's very, very obvious benefits. And that's a very old school entrepreneur mindset, by the way. I mean, if you think of the most successful traditional businesses, let's say born 1930, 50, 60, 70, that are still around today, I would bet you all of them had a very similar mindset of taking care of existing partners, customers, suppliers, shareholders before even worrying about net new ones. So for me, what works as my philosophy has also worked for my portfolio companies the best way. So if you can get the same process from an internal investor that you like, that's not always a given, by the way. Sometimes you also discover, hey, we don't like each other, or you don't like me, I don't like you. Yeah, of course. I mean, but if that is the case, that's always the preferred option.
Yeah.
What do you think?
I mean, I would have to agree. And I think it is what you said, obviously is, as you rightly said, well supported between us and our LPs. And I think there are quite a few examples, and we'll probably not get into that right now, but there's quite a few examples of us doing just that with selection of our portfolio companies as well, where we keep preempting and then preempting again and so on. And now, again, I think the tricky part here is price discovery. But I think if I were to imagine what our portfolio founders in those situations would say with the benefit today of hindsight as to why they did it, I think it is largely down to what you said. It's a validation that the investors or the shareholders who know the business the best are doubling down. And I think it gives them additional certainty of knowing what the process, etc., looks like forward, and that everyone fully knows what they are going into. You don't need to put on like
vision alignment.
Or hopefully you don't need to put on like a salesperson mode to convince a new investor to come in. You can just have, and please reference check our earlier episodes on Practical Nerds for what those conversations mean, including the most recent one, episode 67, for what that looks like. Hopefully, all you need to do is just keep it real, and that's sufficient. And that's, if you're a good founder, hopefully that's just status quo for you, and that's like a very that should be a state of equilibrium for how you fundraise. You just carry on with your business, and your existing partners keep aligning with you.
Yeah, you have to, if building a venture-backed business with VCs owning a substantial portion of your cap table sometimes can feel to a founder like, hey, I used to fly this plane on my own. Now I have all of a sudden 5 or 10 co-pilots reading the map with me, and I can't even agree on the destination. That's the kind of situation you don't want. So really what you want is the fully aligned cockpit. Pilot, co-pilot, flight engineer, all of them knowing the destination, knowing how to read a map, how to communicate with each other. That's vision alignment, mission alignment, process alignment, etc. Now that risk becomes higher the more new people you introduce. Yeah. So
Absolutely.
That's at some point always required. But if you can choose between same offer, internal versus external, I think most of the times you're overestimating what the external benefit will be, and you're underestimating the internal benefit.
Yeah, 100%.
Yeah. Great. Good. I hope that clears it up. In construction tech, Shub, well-executed preemptions, how often do you think a founder can expect that?
My hunch or my guess, without being fully aware of the facts, I think at least the data until now would suggest that it's probably not as frequent as, say, something like AI, for instance, where I think preemptions happen all the time, or much more often. I think in construction tech, and I presume we're talking about external preemptions and not internal preemptions. I think external preemption ironically happens in cases where, now there are special cases where we do find investors or investment professionals who have really gotten invested into the business and then decide to move. Unfortunately, the more common kind of external preemption we see in construction tech is when that business has kind of become obvious. And that is when folks want to preempt, and which is where I think the other risks we have discussed start to manifest as well.
But that's a good time though, right? Because construction AC, it is so quirky and sometimes very difficult for people. I actually don't want the preemption when the business isn't obvious yet, because then I'm substantially more likely to get someone that doesn't have the proper conviction and the longevity to go with my business, unless they're a vertical investor and they have repetition in my space. So so that would be the only preemption that even at a non-obvious state is still making sense in my opinion. But I mean that never happens. That's like
it's quite rare.
And so the only preemption that really makes sense is actually after you're obvious. Because then if you have like the velocity in revenue, you have the NDR, cohorts, etc. Someone then getting excited because they can read your numbers and your business has become legible for them, then you can actually have also a higher certainty that they have the conviction and the longevity. So I think then it becomes a little bit more likely, but overall in terms of numbers, look, these kinds of businesses anyway, like every year we might have 5 or 10 in construction tech that are worthy of that velocity and substance. So maybe 5 or 10.
I suspect not even that many, but
you think less,
but that's you meant 5 to 10 a year.
Yeah.
My hunch would be fewer, but again, it's a knee-jerk reaction.
And then the preemption, let's say pre-Series A, for a Series A, for example, when a company isn't obvious yet, or a good company isn't obvious yet, and that ends up well, I don't know, 2 a year maybe, globally. By the way, globally.
I think that seems closer to the reality.
Now, the preemption attempts that happen, they are far, far, far larger than what we were just discussing. We're talking about the ones that end up happy.
Correct. Exactly.
Yeah. All right, so that was a good topic. Thanks for discussing this.
And thanks for sponsoring it, as you like to say.
All right, sir. See you later.
All right, see you.
Cheers.